So, um, one thing that investors have over the last several years have really called out are extended valuations in the S&P 500 and U.S. stocks more broadly as a reason to be bearish or skeptical about being neutral, having a full weight relative to their target in stocks. And I think there's several points to make here. This chart shows the brown line is a blended price to earnings ratio. It's more trailing than forward looking, but essentially right now, if you take your eyes all the way to the right side, you can see the S&P 500 trades at about 25 times. And so depending on whether you're looking at expected earnings or trailing or a mix of the two, the S&P 500 trades somewhere between 22 and 25 times earnings. And that's expensive. That's full. Full is probably a better word than expensive, full relative to history. But that's only half of the story. The index itself has, we would argue, become higher quality. And one way to measure quality is profit margins. So the dark line on this chart plots the trailing 12-month profit margin for the S&P 500 over the last 20 years, and you can see the trend is up. So if you go back to 2005, that profit margin was about 8%, and now it's about 13 or 14%. Part of that is the composition of the index has become less, let's say, energy and financials heavy and more technology and technology adjacent heavy. And those companies tend to be lighter, they have a lighter asset footprint, so they can generate higher profitability because there's less assets to serve. They also don't need to take on as much debt typically, and so there's a reduced interest cost burden, especially compared to like heavy CapEx industries. Now, some of that might be changing these days with the AI CapEx build out. We're not going to delve too far into that right now. I think we can broach that subject in another recording or webinar. But the main point is, yes, valuations at the S&P 500 level are full relative to history, but this expansion of valuations has coincided with an expansion in profit margins over the last, and it's not just been a recent development. This has been a trend. If you look at the dark blue line on this chart, that goes back to 2005. We circled a spot. There's a couple of spots on this where we see these lines diverge. And in 2022, actually, when we had that 20 or 25% bear market, we saw operating margins come down. We also saw valuation compress as well. If you were strictly going by sort of this relationship, you could say that this disconnect, even though valuations got down to the PE got down to about 15 or 16, 17, which you would say over the long course of history is still not that cheap, because profit margins had really run a long way from, let's say, 7, 8% all the way up to 11, 12%. You could say the market was pretty cheap. And in retrospect, it was pretty cheap back then because now we're, twice or almost three times as high as where we were in the lows in 2022.